America's real estate market is a slow-burning fuse attached to an economic powder keg, and certain states are sitting directly on top of the explosive charge. While headlines celebrate robust home sales and skyrocketing property values, beneath the glossy surface lies a structural crisis that few are willing to acknowledge. Across the nation, 9 states have built their entire economic foundations on overinflated property markets, speculative construction booms, and unsustainable migration patterns that are now rapidly reversing. These aren't just markets experiencing normal corrections. These are economies teetering on the edge of complete systemic failure. Property tax revenues that fund schools, police, and infrastructure are built on valuations that exist only on paper. Homeowners are trapped in properties worth less than their mortgages. Commercial real estate sits vacant as remote work reshapes entire downtown districts into ghost towns. Insurance companies are fleeing, leaving properties uninsurable and worthless. When the next recession hits, and make no mistake, it's coming, these vulnerable states won't experience a gentle landing. They'll face a brutal unraveling that will ripple through banking systems, municipal budgets, and the lives of millions of families who believed the American dream was still attainable. What follows are the 9 states most vulnerable to catastrophic collapse as America's real estate bubble finally bursts and recession takes hold.
Number 9. Nevada. On the surface, Nevada appears to be thriving. Las Vegas continues to draw millions of tourists annually, and Henderson ranks among America's fastest-growing cities. The state's population surged by 15% between 2010 and 2020, fueled by Californians seeking lower taxes and affordable housing. In reality, Nevada has constructed an impossibly fragile economic model that depends almost entirely on 2 revenue streams: gambling tourism and real estate speculation. The state has no income tax, meaning 60% of its budget comes from sales tax and gaming revenue, both of which evaporate instantly during recessions. In 2008, Nevada's unemployment rate hit 13.7%, the highest in the nation, and home values plummeted by 62% in Las Vegas alone. Today, that same vulnerability remains, but is now amplified. The average Las Vegas home price jumped from $310,000 in 2020 to $482,000 by late 2023. A 55% increase driven purely by speculation and pandemic migration, not by wage growth or economic fundamentals. Nevada's median household income sits at just $66,000, making these homes mathematically unaffordable for the average resident. Meanwhile, commercial real estate vacancy rates downtown have climbed to 19%, as convention traffic remains 30% below pre-pandemic levels. Water scarcity adds another existential threat. Lake Mead has dropped to just 27% capacity, and when the Colorado River Compact forces cuts to Nevada's water allocation, construction and growth will halt entirely. The moment recession hits and tourism dollars dry up, Nevada's municipal budgets will implode, property values will enter free fall, and the state will find itself exactly where it was in 2008, only this time with far fewer options and much deeper structural debt. Nevada isn't just vulnerable, it's a ticking time bomb waiting for the smallest economic shock to detonate.
Number 8. Arizona. Arizona markets itself as the affordable Southwest alternative, drawing retirees and remote workers with promises of sunshine, low taxes, and spacious homes at reasonable prices. Phoenix became the fastest-growing city in America in 2022 and 2023, adding over 100,000 residents annually. Beneath the surface, however, Arizona's boom is built entirely on borrowed time and borrowed water. The state faces the same catastrophic water crisis as Nevada, but with even less infrastructure to handle it. The Central Arizona Project, which supplies 50% of the Phoenix metro area's water, is facing mandatory cuts that could reduce supply by 30% within 5 years. When water restrictions force developers to halt construction, which accounts for 18% of Arizona's GDP, the entire economic engine will seize. Real estate prices in Phoenix jumped 58% between 2020 and 2023 from a median of $295,000 to $465,000, while median household income rose just 12% to $72,000. This means the average family can no longer afford the average home. Yet builders continue constructing 40,000 new houses annually, flooding an already oversaturated market. Inventory has tripled since 2022, and homes are sitting unsold for an average of 87 days, up from just 18 days in 2021. Arizona's economy remains dangerously dependent on construction, tourism, and retirees, all of which vanished during recession. The state's rainy day fund covers only 8% of annual spending, leaving virtually no cushion when tax revenues collapse. Insurance companies are already fleeing. State Farm stopped writing new homeowner policies in Arizona in 2023 due to wildfire risk and inflation. When recession combines with water shortages, insurance crisis, and construction collapse, Arizona won't experience a gradual decline. It will face a sharp, brutal contraction that leaves millions of homeowners underwater on mortgages for properties they can neither sell nor insure. Number 7. Florida. Florida has dominated migration headlines for 5 consecutive years, with 319,000 people moving to the state in 2022 alone, drawn by zero income tax, year-round warmth, and a perceived affordability advantage. Real estate developers have responded with a construction frenzy, adding 200,000 housing units annually across Tampa, Orlando, Jacksonville, and Miami. In reality, Florida is constructing a demographic and financial house of cards that cannot withstand even a moderate economic downturn. The state's insurance market has already entered a death spiral. 6 major insurers have gone bankrupt since 2022, and average homeowner premiums have skyrocketed 57% to over $6,000 annually, the highest in the nation. Citizens Property Insurance, the state-backed insurer of last resort, now covers 1.2 million properties and is catastrophically underfunded. A single major hurricane would bankrupt the entire system. Meanwhile, property prices have become completely detached from local incomes. Miami's median home price hit $595,000 in 2023, while the median household income sits at just $44,000. Tampa saw prices surge 78% in 3 years, yet carries the dubious distinction of being America's most overvalued market, according to Florida Atlantic University's housing analysis. Inventory is building rapidly. Active listings jumped 89% year over year in 2024, while sales plummeted 23%. Commercial real estate tells an even darker story. Downtown office vacancy in Miami stands at 22% as companies embrace permanent remote work. When recession hits, the transplants who drove Florida's boom will reverse course immediately. They have no roots, no family ties, no reason to stay when jobs disappear. Property tax revenues will crater, leaving municipalities unable to fund services. Construction, which represents 14% of Florida's economy, will halt overnight, triggering mass unemployment. The state that everyone believes is recession-proof will discover it's actually the most exposed of all.
Number 6. Texas. Texas proudly brands itself as America's economic powerhouse, boasting 30 million residents, Fortune 500 headquarters relocations, and a business-friendly environment that has attracted hundreds of billions in corporate investment. Austin, Dallas, Houston, and San Antonio all rank among the nation's fastest-growing metros, with population surges between 15 and 25% since 2020. Dig a little deeper and you'll find an economy dangerously overextended and built on a foundation of unsustainable sprawl, energy sector volatility, and speculative real estate that's already showing cracks. Texas added 470,000 new housing units in 2023 alone, more than California, Florida, and Arizona combined, flooding the market at precisely the wrong moment.
Austin's median home price exploded from $360,000 in 2020 to $620,000 by mid-2023, an increase of 72%, driven entirely by tech worker migration that's already reversing as companies like Tesla, Meta, and Google implement layoffs. By late 2024, Austin home prices had dropped 11% from their peak, inventory had tripled, and homes were sitting unsold for 95 days. The same pattern is emerging in Dallas and Houston, where new construction continues at a blistering pace despite rapidly weakening demand. Texas's economy remains deeply tied to oil and gas, despite attempts at diversification, with energy representing 18% of state GDP and oil prices directly correlating with tax revenues and employment. When oil crashed in 2015-2016, Houston lost 75,000 jobs, and home prices dropped 15%. Today's oil market faces structural headwinds from renewable energy transition and global demand uncertainty. Texas has no state income tax, meaning it depends almost entirely on property and sales taxes, both of which evaporate during recession. The state's power grid remains dangerously fragile after the 2021 freeze killed 246 people, and its lack of regulation means homeowners face insurance premium increases of 40% since 2020. When recession hits and tech companies continue downsizing, when oil prices decline, when the construction boom turns to bust, Texas will experience the very economic devastation it claimed could never happen within its borders. Number 5. Idaho. Idaho became the poster child for pandemic-era migration, with Boise ranking as America's hottest housing market from 2020 through 2022, experiencing price growth that exceeded even Austin and Phoenix. The state's population grew by 2.9% annually, the fastest rate in the nation, as remote workers fled expensive coastal cities for mountain views and lower costs. Beneath the surface, Idaho has engineered the most spectacular real estate bubble in modern American history, one built entirely on temporary migration trends that are already reversing with devastating consequences. Boise's median home price rocketed from $380,000 in early 2020 to $569,000 by May 2022, an increase of 50% in just 26 months, the fastest appreciation ever recorded in a major American city. This occurred despite median household income of just $63,000, creating an affordability crisis where teachers, police officers, and healthcare workers were priced out entirely. The bubble has already begun imploding. By late 2024, Boise home prices had crashed 16% from peak, the steepest decline in the nation, while active inventory increased 312% as sellers panic and demand evaporates. Idaho's economy has virtually no diversification. There are no major corporate headquarters, no significant manufacturing base, no tech industry beyond a few small data centers. The state depends almost entirely on construction, agriculture, and tourism, with construction representing 22% of GDP, the highest dependency rate in America. Building permits have already collapsed by 47% year over year as developers realize they've oversaturated a tiny market with limited employment opportunities. Idaho has attracted predominantly remote workers whose companies are now mandating return-to-office policies, forcing them to either relocate back to major metros or lose their jobs. The state that symbolized pandemic-era opportunity will become the cautionary tale of what happens when an entire economy is built on a temporary migration fad that ends as quickly as it began. Number 4. Utah. Utah consistently ranks among America's best-managed states, with AAA credit ratings, budget surpluses, low unemployment, and a diversified economy that includes tech, finance, tourism, and outdoor recreation. Salt Lake City and Provo have attracted major corporate investments from Adobe, Goldman Sachs, and dozens of Silicon Valley companies opening secondary offices. In reality, Utah is experiencing the exact same speculative real estate bubble as Idaho and Arizona, but with even less acknowledgement of the risks because its strong reputation masks the underlying fragility. Home prices in Salt Lake City increased 67% from from 2020 to 2023, rising from $425,000 to $710,000, while median household income grew just 14% to $86,000. The state added 135,000 new residents between 2020 and 2023, overwhelming infrastructure that was never designed for such rapid growth. Utah's legendary efficient governance cannot overcome basic mathematics. When housing costs increase 5 times faster than wages, collapse is inevitable. The state's tech sector, which drove much of its recent growth, is already contracting. Silicon Slopes companies have announced 12,000 layoffs since mid-2023, and the remote work trend that brought high-earning tech workers to Utah is reversing as companies like Meta, Amazon, and Google mandate office returns. Construction represents 16% of Utah's economy, and building permits have declined 38% year over year as of Q4 2024. Commercial real estate vacancy in downtown Salt Lake City has climbed to 17%, and several major office buildings sit completely empty as companies downsize. Utah's vaunted fiscal management can't protect it from the reality that its housing market became completely decoupled from economic fundamentals. The state faces an additional crisis unique to its geography: water scarcity. The Great Salt Lake has shrunk to just 30% of its historic size, and when it dries up completely, which scientists predict could happen by 2028, it will expose toxic dust beds that will render Salt Lake City unlivable. Utah built its modern prosperity on unsustainable growth, and when recession forces a reckoning, its fall will shock those who believe good governance alone could prevent economic disaster.
Number 3. North Carolina. North Carolina emerged as the darling of corporate relocations, with Charlotte becoming the nation's second-largest banking center, Raleigh-Durham building a world-class research triangle, and the state attracting over 500,000 new residents between 2010 and 2023. Fortune 500 companies relocated headquarters, tech giants opened major facilities, and the state's moderate climate and lower costs created what appeared to be the perfect growth formula. Beneath the surface, North Carolina has constructed an economy precariously balanced on corporate decisions that could reverse overnight, and a real estate market that's already showing signs of severe overextension. Charlotte's median home price surged from $285,000 in 2020 to $465,000 by 2024, an increase of 63%, while Raleigh jumped from $315,000 to $495,000. Both cities now rank among America's most overvalued markets relative to local incomes and rental yields. The state added 87,000 housing units in 2023, but 40% of buyers were investors, not residents, creating artificial demand that's already evaporating. Investor purchases have dropped 54% year over year as returns collapse and vacancies rise. North Carolina's economy depends heavily on banking and finance. Charlotte hosts Bank of America's headquarters and Wells Fargo's East Coast operations, sectors that shed jobs immediately when a recession hits. In 2008, Charlotte lost 38,000 finance jobs and home values declined 21%. Today's banking sector faces additional threats from rising commercial real estate loan defaults, with $1.2 trillion in commercial mortgages maturing between 2024 and 2027. If even 15% default, Charlotte's banks will face another crisis. The research triangle, while strong in biotech and pharmaceuticals, has also attracted tech companies that are now downsizing aggressively. The state's reputation for business-friendly policies cannot protect it when the companies it attracted begin consolidating operations back to primary headquarters during cost-cutting drives. North Carolina built its prosperity on corporate relocations that were driven by temporary pandemic-era remote work policies that are now being systematically reversed, leaving the state holding overpriced real estate and infrastructure built for growth that will never materialize.
Number 2. Colorado. Colorado represents the American dream in modern form. Spectacular Rocky Mountain landscapes, thriving craft brewery and outdoor recreation industries, a booming tech sector in Denver and Boulder, and a progressive culture that attracts young, educated professionals. The state added 350,000 residents between 2010 and 2023, and Denver became one of the nation's hottest real estate markets, with median prices climbing from $375,000 in 2020 to $635,000 by late 2023. In reality, Colorado has engineered the most precarious combination of unsustainable real estate speculation, climate vulnerability, and economic dependency on discretionary spending in the entire nation. Denver's housing market is now mathematically impossible for the average resident. Median household income sits at $85,000, while the median home costs $635,000, a ratio of 7.5 to 1 that historically predicts severe correction. First-time buyers have been completely priced out, and the market depends entirely on wealthy out-of-state transplants, whose migration is already slowing dramatically. Colorado's economy is dangerously concentrated in sectors that disappear instantly during recession: tourism and outdoor recreation, craft beer and restaurants, cannabis retail, and tech startups. When discretionary spending contracts, all four sectors collapse simultaneously. The state's ski industry, which generates $5 billion annually, faces an existential climate crisis. Snowpack levels have declined 30% since 2000, and several resorts have been forced to close early multiple seasons in recent years. Insurance companies are fleeing Colorado at an accelerating rate due to wildfire risk. State Farm, Nationwide, and Allstate have all restricted new policies, and premiums have increased 47% since 2020. Wildfire destroyed 1,084 homes in Marshall Fire in December 2021, causing $2 billion in losses and rendering entire neighborhoods uninsurable. Colorado's water supply depends on snowpack that's steadily diminishing, threatening agriculture, municipal supplies, and the outdoor recreation economy simultaneously. The state's political environment, while attracting progressive professionals, has also triggered a corporate backlash, with several companies quietly relocating operations to Texas and Tennessee to avoid higher taxes and regulations. When recession hits, Colorado's economy will unravel quickly because every sector that drives growth, real estate, tourism, discretionary retail, tech, disappears at once, leaving a state with crushing housing costs, climate crises, and no economic foundation to support recovery. Number 1. California. California is the world's fifth largest economy, home to Silicon Valley, Hollywood, the nation's most valuable agricultural output, and cities that define American culture and innovation. Los Angeles, San Francisco, San Diego, and Sacramento attract global talent, drive technological advancements, and generate more wealth than most nations. The state's GDP exceeds $3.9 trillion, larger than India or the United Kingdom. Dig a little deeper and you'll discover that California is actually America's most vulnerable state, a slow-motion economic disaster already in progress, masked only by the enormous wealth concentrated in a tiny percentage of residents, while the majority face conditions more aligned with developing nations than the world's innovation capital. California has lost over 1.2 million residents since 2020, the largest outmigration in state history, as middle-class families flee unsustainable costs. The median home price statewide is $798,000, more than 8 times the median household income of $91,000, making home ownership mathematically impossible for teachers, nurses, police officers, and the entire working class that keeps society functioning. San Francisco's median price is $1.4 million, while Los Angeles sits at $925,000. Homelessness has exploded to over 181,000 people, up 40% since 2015, with entire neighborhoods transformed into open-air drug markets and tent cities that spread disease and crime. California's tax base is catastrophically dependent on the ultra-wealthy. Just 1% of taxpayers pay 50% of state income taxes, meaning a single stock market crash or tech downturn vaporizes revenues instantly. This happened in 2001 and 2008 and will happen again.
The state's budget deficit for 2024-2025 is $68 billion, forcing cuts to education, healthcare, and infrastructure despite being the world's fifth largest economy. Commercial real estate is in free fall. San Francisco office vacancy hit 36.7% in Q4 2024, the highest in the nation, with buildings selling for 60% less than 2019 values. Major retailers are fleeing Los Angeles and San Francisco due to organized retail theft that police no longer even investigate. California's electrical grid is so outdated that utilities shut off power preemptively during fire season, leaving millions without electricity for days. PG&E, the state's largest utility, has already declared bankruptcy once and faces $30 billion in wildfire liabilities. Insurance companies have entered a death spiral. State Farm, Allstate, and Farmers have all stopped writing new homeowner policies, leaving hundreds of thousands of properties uninsurable and unsellable. The state's water system, built in the 1960s for 18 million people, now serves 39 million and is collapsing under the strain. California has become a two-tier society, billionaires in Silicon Valley and coastal enclaves, and everyone else drowning in costs they cannot afford, living in a decaying state that still believes it's a paradise while Rome burns around them.